So I guess we'll get started, and as people trickle in, they'll just sort of catch up. Um, Maybe I'll start with just a little background on my relationship with Equinox Gold, so everybody knows where sort of I'm coming from. Um, I run a long short equity hedge fund that focuses on energy materials and industrials. Uh, my fund first sort of came across Equinox in 2018. We really built our first position in 2019. We sold down some of that position in 2020 and then rebuilt it in 2022, 23, and are now enjoying sort of our second go round with Equinox. I visited most of the assets, and knew the previous management team very well. But interestingly enough, we thought this was sort of an interesting variable in this conversation. Darren and I have never talked. And so this is actually the first conversation we're having. So longtime shareholder, strongly supportive of the strategy sort of from the beginning, and look forward to sort of the company under Darren's leadership and as it continues to grow. So I guess I would start off, Darren, by just asking you maybe if you could just give the audience a little bit of your background, because I mean, you've got, is it 6 or 7 mine builds under your sort of leadership across various different companies? And, so a long history in the industry and a long and sort of successful history in the industry.
Yeah, no, thanks, Will, and appreciate making the time. And it's great to meet for the first time. We had a little bit of banter in advance of going live here, so it's great. And, appreciate your support, massive support through the journey, right? There's been some ups and downs along the way, and we're clearly in an inflection point now. So we'll talk more about that as we go forth. But I came into Equinox upon the close of the transaction and merger between Equinox and Calibre. I was the CEO of Calibre. I'd been one of the founders of Calibre in its current form or prior to the transaction with Equinox. I came into that business in 2019 when we had an exploration company in Nicaragua, and we looked at an opportunity to get some production with growth opportunity, and we purchased assets from B2Gold. At the time, we raised $60 million in the summer of 2019 and closed that transaction in Q4 of 2019, and then grew those assets from what were at that time basically zero reserves, effectively, about 60 to 70,000 ounces a year coming out of Limon. These assets had 2 mills, one in Limon in the north and the second at Libertad in the south. And Libertad was foreshadowed to go into closure in 2020. And we looked at those assets and said, looking at these a little bit differently, we had a mill bound or mill rated kind of bottleneck at Limon. Let's take some of the material from Limon to Libertad, and then allowed us to be able to grow that asset base from what was 60 to 70,000 ounces a year to 250,000 ounces a year, and then also add reserves. And we've got the reserve base up to currently just over 1 million ounces of reserves. And that's what allowed us to, kind of then go in and do a beachhead acquisition of Fiore Minerals in 2022 for Pan in Nevada, and then continue to build cash, and allowed us to come in and do the strategic acquisition of Marathon for Valentine at the end of 2023, and we closed that in 24. So that's a little bit how I got into the Equinox piece. But now if I go back pre-Calibre, I was with the same family of companies. We did a transaction that some people may be familiar with as Newmarket Gold, when we purchased some distressed assets out of a hedge fund in New York, in Australia for about $50 million. And it was 3 mines in Australia, Cosmo in Northern Territory, Fosterville, which some people are probably familiar with in Victoria, and then Stawell in Victoria. And we saw a unique position here with underloved, underinvested assets to be able to put some money into exploration, as we loved what we saw at Fosterville. So we raised some money, bought those assets for about 50 million, and then 18 months later, we vended them into Kirkland Lake Gold for $1 billion. So that was kind of my history with this funds. But now if I go back, probably more importantly, to the 30 years prior to joining this family in 2015, I spent 30 years with Newmont. And I won't date myself by saying what I did prior to Newmont, but in 1986, I joined Newmont in Australia at a mine called Telfer when it was residential, as a kind of a newly minted mine engineer, and then spent 4 years there kind of learning the crafts of the trade, living on site. It was pre-FIFO. And then in 1989, I was asked to move to the US with Newmont and finish the construction and commissioning of Gold Quarry, which was one of those cornerstone assets for Newmont back in the day. And kind of grew production, built the mill, or finished building the mill, commissioned the mine, put those assets together. And then in 1994, the leadership asked me to go to Indonesia for a couple of weeks to look at an asset, which they were struggling to get into something that made sense. So I went across for a couple of weeks, looked at it. We did some changes in the mine plan, and we saw a great opportunity to mine faster than what the process plant envisaged at the time could handle, stockpile the lower grade, process the higher grade to get advanced cash flow and produce something that made sense. And it was important for a number of reasons, because it was a relatively small facility, a 2,000 ton a day fluidized bed roaster, but it was also had submarine tails, which is kind of a precursor to what was Batu Hijau. So it was an enabler for Batu Hijau in addition to making money in its own right. So given I turned the plan around and they said, look, hey, that makes sense. They said, well, why don't you stay there and make it happen? So I was like, okay. So I spent the next year doing the final engineering, did the build, commissioned the plant, spent a year. And they said, well, now that's done, we've got this other opportunity in Peru. And at that point, it was Mineria and Allocation, which some people will be familiar with. And at the time was producing about 60,000 ounces a year. And I went there on the pretense of converting a contract miner into an owner mining. And then over the subsequent 7 years, grew that production base from 60,000 ounces a year to about 2 million ounces a year. And then in 2003, was asked to go back to Indonesia at this point at Batu Hijau. Batu Hijau had been built. It was a great build, but it had been conceived at $400 gold and $1 copper, but it had been born into 67-cent copper. So it needed some operating expertise to be able to ensure that we could lower operating costs to be able to be profitable at what was a much lower copper price than what it was conceived at. So that was the drive there, was to get operating efficiencies. And that's when I first met Dave Schumer, who was a mine superintendent at Batu Hijau then, who subsequently, 30 years later, became a COO for Calibre. And we maintained contact through the Newmont journey. But we grew that business, and at one point we're generating about $1 billion a quarter in free cash flow. I left Indonesia in 2010 to Australia, and it was to capture Boddington as it had just been born, and it had a bit of a breech birth, had some difficulties. So I needed someone to go in there to kind of right size and convert that from a construction commissioning into an operation. So I spent a year there, and then a year later I ended up running all of Newmont's assets in Australia Pacific, which at that time was about 40% of Newmont's EBITDA, and 7 mines, 15,000 people across Australia, New Zealand, and Indonesia. And then I left Newmont in 2015 to join this family of companies, which was the antithesis of Newmont. But it was an opportunity to take that 30 years of history and knowledge and then put it in a fit-for-purpose organization and be able to push buttons and immediately see the benefit from. So sorry for the long-winded discussion there, Will, but that's kind of a little bit of the history. So I'm a builder, operator, optimizer. I'm not a capital markets. I'm not an external focused guy for the better part. I'm all about internally focused, and again, they drag me out to be able to talk to folks like you because it adds credibility to the story.
No, but I think while it's a long story and a great career, I think it was I think you highlight a couple of important things for people looking at Equinox now or existing shareholders. I know that we have the shareholders in Equinox. There have been some teething issues, as we've consolidated assets. And so your background, as what struck me in you reviewing your background is, being flying in, troubleshooting, mines that are operating, mines successfully. Those are both those things we need right now. And then buying assets well, which I think the history of both Calibre and Equinox is, as consolidators, and critical to consolidation is sort of buying well, and you've both done that quite successfully. So I think that that history really validates some of that. But so with that, I guess, in mind, Caliber merged with Equinox this year. You're sitting there in January of this year. You guys are about to turn on Valentine. Gold price is good. I think you would have been about 500,000 ounce producer once Valentine was all up and running. What did you see in I know Greg and the Equinox team, I think, approached you guys about the possibility of a merger. What did you see sitting there in January, February of this year about that merger that made sense and sort of in your head said this is going to create a lot of shareholder value?
Yeah, no, and again, I think how this came to pass was really, Ross had a vision working with Greg to develop critical mass in Equinox, but there had been some delivery issues along the way. So that's kind of where Equinox 1.0, I guess, was positioned. If we think about coming out of the summer of 2024, is that they had the bits, but they were struggling to surface that value from the bits. At the same time, on the Caliber side, we'd had a reasonable level of success as we'd gone from a 60-cent share price in the end of 2019 to a $3 plus share price in that 5-year period. So we'd grown the business, created some shareholder value. We're on the cusp of bringing in Valentine. It's like, well, what's next? So if we start to take a long-term view, the natural combination of these two asset bases made a lot of sense, because you ended up tearing up from an overall asset perspective with ending up with two cornerstone Canadian assets, and you tear up the leadership team as well by augmenting what was a great team in place at Equinox with filling some gaps that didn't exist, right? Or a little bit maybe wanting from an operations perspective. So that was kind of the genesis of. So looking back, I'm a significant investor in Caliber. I'm a significant investor in Equinox. I mean, I have in excess of 70% of my net worth involved in this product, right? So what interests people on this call fascinates me, right? Because we're absolutely aligned. I mean, I'm not here to build a mining company. I'm here to create shareholder value through share price appreciation. That's my reason for being. And we do that through responsible delivery of value from mines. So, that was kind of the genesis of, it's just like, what's next? Right, we get Valentine. Yeah, we would have seen a re-rate. We would have taken from in a flat gold price environment, we would have went from probably $3 to $4 and change. But then what? Right, we saw great exploration potential at Valentine, but let's how do we get some more critical mass and become more of a major within the space? And that was the opportunity here with Equinox.
So I think again, we talk about the shareholders and people who have been with Equinox for a while. You keep talking about sort of Ross's vision. So Ross Beatty, for those who are unfamiliar, is the chairman of the board and sort of got the ball rolling with Equinox, American Silver. So has a long history, very successful mining entrepreneur. He's been talking about 1 million ounce producer for a while. He's also been sort of harping on the idea that scale in volume of ounces in the company, the balance sheet, et cetera, is critical to sort of being a successful gold miner. Now, this idea of scale is interesting for shareholders. I've come across shareholders who, quite a few, who just don't sort of grasp the idea of what the value to them of the company continuing to gain scale is. Maybe you can sort of answer that question better than I have for them. So what do you think the value in scaling the business is?
Yeah, no, and I think and I'd be careful. The only thing I'd put a bit of precursor on it is growth for growth's sake is not a good thing. I did a lot of that for Newmont. I enabled that. I didn't set vision, but I built, grew mines, acquired assets during that 30 years to be able to deliver into that. So I know how to do that. But what I did see through that was arguably some value destruction along the way because of growth for growth's sakes, as opposed to what was the purpose by. And not all ounces are created equal. So we've got to make sure we've got quality and quantity, not quantity over quality, right? So getting significant and big material in size actually attracts in a different capital pool into the space. That's really the key for us. It makes us to the point where we can start to attract in the more generalist funds who want to have diversity, want to have leverage to gold, or the more ETFs into the space, which creates more liquidity in the product, which allows for those that want to get in, get out, which needs to happen. Everyone needs an exit strategy out of their investment. So, it makes us a more robust product that you can't be ignored. But it can't be adding production that doesn't have a margin. Right.
Yeah, so I mean, I think that makes a lot of sense, and I've supported that sort of idea and strategy. I know it's been tough for some shareholders to wrap their hands around, but I think it makes a ton of sense. You talk about not growing, you sort of mentioned there, obviously not all ounces are created equal. So as Equinox has grown and as it has consolidated and acquired assets, and I've thought it's done a spectacular job of that, the balance sheet has also become, it has some debt on it. I don't think it doesn't seem particularly egregious, but there are concerns about it. Now, you and the team have talked about sort of a rapid deleveraging going forward. I was wondering if maybe you could just speak to what your vision for the balance sheet is over the next 12 and 18 months.
Okay, sure. And, if I think about, creating shareholder returns by consistently delivering on its commitments, and that's nomenclature or, rhetoric that you'll hear from me always. It's about being absolutely transparent on what you're going to do and then deliver into that, right? We will create that shareholder value by firstly demonstrating operational excellence, right? The single largest talk to Equinox going forward is increasing the level of confidence that people have in Equinox to deliver on its commitments. We've done a fantastic job over the last 5 years at amalgamating and consolidating into a great production base, but we've been challenged to deliver into those expectations. And that's really the talk that we saw as coming in from Calibre as we took out $2.5 billion because, 6 months ago, we were sitting on your side of the table looking at this product and going, hey, why would we put our money in it? And what we saw was we saw good people, we saw good assets, but there was something missing from the delivery piece. So coming in there and we can add that into to be able to surface value out of those assets. So that's the single largest driver for our product going forward is it to regain credibility. Because if you look at our share price performance, we've had a modicum of success over the last 3 or 4 months if we've doubled share price. But if you look at where we sit with respect to our peers, we're still significantly undervalued with respect to how the Equinox has performed since the start of 2022, when we've seen an increasing price from a gold price perspective. And we've also seen the birth of what prior to the merger with Calibre was the birth of a North American tier 1, long life, relatively low cost asset in Greenstone. And it hadn't surfaced that value. Why not? Because there wasn't yet the confidence in the product. And that's been a focus of mine, is to get in front of folks, talk to them and say that this is what we're going to do. We've lowered expectations on some of the assets because at the end of the day, there was some overpromise and underdeliver. Well, that doesn't, as a deployment of capital as an investor, it's just like you look at that risk reward and it's like, well, am I confident in, right? It's really important that people trust us. Advance.
And so
Sorry.
Maybe you could just talk to, you've mentioned a couple of times, all the bits and pieces were there for Equinox, especially when you sort of add in the Calibre assets. But there was that shortfall in terms of delivery. As a long-term shareholder, I've often been confused by, some of the shortfall in delivery I chalk up to, it's the mining business and it's a hard business, and execution in the real world is much harder than execution in the software world or something like that. And so there are always going to be challenges. But, without perhaps tossing Greg or anyone else under the bus too badly, what do you think caused the shortfall in execution up to this point in Equinox, and how are you guys specifically looking at addressing that?
Yeah, no, Greg did a fantastic job at working and consolidating that period, that group of assets. And that's where his expertise in space is, right? He's a very talented and canny business person from a deal perspective. But, you know, and if we were in an acquisition mode, he's the guy to run the business. If we're looking at delivery mode and making business boring from an investor perspective in terms of what they say is what they do, that's not what Greg's background is. That's what mine is. And that's why it made sense. And then Greg realized that as we got through the transaction, well, look, he's how do you say, nurtured the product for the last decade to get to that point. It's a logical transition to pass it across as we go into that next phase of. So it's recognizing where your strengths are, and more importantly, where the deficiencies are, and then how to then augment that. So it was a natural transition. So we didn't necessarily, as Equinox, have the operating pedigree within the business to be able to deliver the promises of. And you're into that M&A space, you were dealing, you're adding things in, but then you needed to, you're a little bit like the dog that caught the car. You're chasing the car, but what do you do with it when you get it? You know what the car can do, but how do you manage it versus it managing you? So you need to get ahead of it. And you mentioned that you know the mining space is fraught with a level of uncertainty. But I think about Calibre, you know, we were 23 out of 24 quarters. We had delivered into expectations out of an asset base that was in Nicaragua, which was previously ran by B2 Gold, which was perceived, which is a good operator. And it was just like, hold on, you know, there's something different in that, right? So it's the pedigree of the people that we come in who every day come to work focused on delivery in, understanding where the risks are, getting ahead of them, addressing them. And when things do go bump in the middle of the night, we get out in front of it and we say, this is what's happened, this is what we're going to do about it, and then we deliver into the corrective, right? It's not very difficult, but it does take a lot of experience in the space, right? And understanding that asset base. And I think that was kind of it was just a change in model that we're poised for. And that's what we saw. We saw the opportunity was to be able to shore up the delivery aspects. And we got great people throughout our business. But there were a couple of specific gaps that we've been able to augment. And then we start to have a little success. Well, that makes people, instead of looking down at their shoe leather, starting to chest out, head up, thinking about, hey, what is it? Nothing breeds success like success. And that's what we're starting to see now, is we've kind of turned a corner. First step in that was to set expectations that people could deliver into, right? So instead of people going, well, we didn't get there because of, and explaining, they feel good about themselves. And then they're willing to come to work every day and take intelligent risks on behalf of the business. So it's like changing that ethos within the business. And it's doing it with a level of pace as well. It's clarity in. Every role in the organization is critical to the delivery of the product of creating shareholder value. If it's not, then the role shouldn't exist. And if the role doesn't exist, how do we repurpose that asset in terms of that person to be something that's accretive to the bottom line, and getting people aligned behind that? So we haven't walked away from our volume mantra, but I take that out of our lexicon now. We're not interested in 1 million ounces. It could be 900,000 ounces or 1.2 million ounces. We need critical mass. But what we need to be focused on is surfacing shareholder value. And, you know, personally, I'd rather have 900,000 ounces a year at $1,000 margin than 1.1 million ounces at a $500 margin, right? Because I'm going to create more free cash flow, which is going to provide a more robust product, which is going to allow us to be more opportunistic when other businesses do things that present us with the opportunity. And that was our strategy with Marathon, right? You know, we were this Nicaraguan-based company who then took an opportunity, because of the situation the company had got itself in, to trade at a 5-year low, come into a private placement, give them a little bit of time to make an intelligent decision, and say, this is why accepting our offer from an all equity position in this will be really accretive for your shareholders, because they'll participate in the upside as we re-rate the product, right? And they've seen that, right? I mean, if we look at where Equinox sits today and we track that back through the share exchange ratios back to Marathon are trading at, you know, they've had a four-time return over the last 18 months. So that's kind of the value proposition, is looking things a little differently. It's not all about volume, but volume is critical to maintain relevance, but it's making sure that you get the torque from the volume you add.
No, that makes a lot of sense. And sort of you bring up this will tie back actually a little bit to my question about the balance sheet. You talk about free cash flow, and when I sit down and model the company and look at, say, free cash flow just next year, so not out very far, obviously, I see no reason why the company can't do, in excess of $1 billion in free cash flow, especially if gold stays where it is. At the same time, I'm seeing a lot of, on the sell side and in places like Mining Journal or mining.com, a lot of discussion of, rapid deleveraging. And then, oh yeah, by the way, at the bottom, there's always this paragraph that says something along the lines of they've got Los Filos they could sell, they have Brazil that they could sell, and these activities could support rapid deleveraging. It seems to me that you guys can rapidly delever without selling any assets because of the free cash flow. So, I guess, is there something behind that, repetition that I'm seeing in discussion of selling assets? Is there some thought process that you guys should sell an asset internally? And if so, I guess why, given the free cash flow potential of the assets we've currently got over the next couple of years?
Yeah, no, well, and it's a perplexing problem, right, in a first world sense. And Equinox is a different product today than it was 6 months ago, than it was a year ago. So, one of the things that I think all issuers battle with is the definition of core versus non-core. And I think once you start to put things in a bucket of whether it's core or non-core, you run the risk of leaving value on the table. I'll use an analogy where, I'm not sure if you have kids or not, but you love all your kids, but sometimes your kids kind of a little bit more frustrating, and for the right price, you gladly sell one, right? There's a clearing price at which, okay, you can have him or her, right? And depending on the day, the environment, they are worth more or less to you depending on where you're at and where the environment sits at. So, I think about, our situation right now. We've got $1.3, $1.4 billion in net debt. To your point, there's no reason to suggest that we can't create in excess of $1 billion of free cash flow next year, which significantly delevers the balance sheet, clearly. But we look at some of our assets and go, if there's an opportunity to advance that deleveraging quicker, and in the short term, you may be giving up some free cash flow yield that allows you to be more robust if things turn, or to position yourself to be able to ensure that you're well funded for that organic growth, or in 2 years' time, you've got a war chest from a cash perspective to go out there and do acquisitions without further dilution. You've got to say, okay, what's the best decision? So the way I've characterized the business is not that we need to divest anything. We don't. But basically everything we own, we transacted on to get here. We'll gladly transact on it again if there's a price that makes more sense and it creates value in your hands. Sorry, when I say the asset, is it more valuable to our shareholders in our hands or someone else's hands? And that what we want to do is always make the least wrong decision we can. So if we look at the perspective of someone's willing to come in and pay, $1 billion for Brazil, just say, right? And then we look at the cash flow yield that comes out of that asset. We say, how does that figure in? What's that payback on that $1 billion? What other uses of capital do we have for that? And so then you make a decision. It's not that we're committed to sell. We own all of our assets because they make sense for us and we're comfortable to operate them all. And we see great growth opportunities in all of our asset bases, but it's being objective about and not falling in love with a mantra, right? And it's maintaining that objectivity to be critical at everything you do every day to ensure you're making the best possible decision on the day. And you don't get kind of, blindsided by a mantra that you established 6 months ago that's not valid today. So, and again, to my, in my simple mind is that I always kind of keep that reference of how do we make the least wrong decision we can? Because in a year's time, whatever we do today, with the benefit of hindsight, we could have made a different decision. But I want to make the best decision. So if someone's willing to come and give us something, we say, no, that's worth more to us in our hands than it is in yours. Or no, it's worth more to our shareholders in their hands. So we'll depart with it. And depending on where you are in your cycle of debt, structure, organic growth, things can become core and non-core. I think that when you run the risk as a business of saying that this is core because it fits a size or a margin profile, I think you're leaving value on the table. And, part of the reason I left Newmont was because, I wanted to get more into this space, because one of the transactions I did at Newmont, much to my reticence, was as selling Jundee into a company called Northern Star, right? And from memory, it was a $90 million Australian transaction, which they got back in the first half after selling the asset, which was basically the genesis of what allowed Northern Star to be what it wanted to be. And it was because at the time, Newmont had put a boundary on it, said, this is what we want. And that's fine. You need a business model. And that was their business model, right? But, I saw there was some opportunity that people, had disposed of asset that provided more opportunity for others than what they should have. It was more valuable to us.
So there's an interesting thread in there. So I viewed Caliber and Equinox as sort of at a very fundamental level. They were consolidators, and they started both by purchasing an asset really well, leveraging that smaller asset into cash flow that then allowed them to bootstrap into the next larger asset, larger series of assets. You bring up the case here of Northern Star, who's done it. It's a business model that's been done several times successfully by gold miners. We now have a rip-roaring gold price. We've had a streak of a fair amount of M&A in the sector. Is that still, and this obviously is less applicable to Equinox now. It's not where you guys are as a company, but do you think that strategy still works as well at these gold prices, or does it work better at these gold prices? Should we expect to see more of that? And there's a constant drumbeat in the industry to consolidate further. Does that drumbeat sort of miss the point on that business model that has been deployed so successfully so many times in the gold mining industry?
I think the model makes sense in any price environment. You've just got to be cognizant of what that price is and what that input is, and how does it change that asset in your hands. And that was my point, right? Is that something that is a $250,000 producer that has zero margin at $2,500 gold, that now has a $1,500 margin at $4,000 gold, provides you with an opportunity. And you say, how do you realize that opportunity, and how does it figure into the other options that you could have for that asset, right? So no, I think the model makes sense. It still makes sense. It's just an input. Gold price is just an input. I think the trick is the decision you're making about what do you anticipate metal prices to be longer term, right? And we've got a bit of confusion out there right now because we've seen a significant increase in gold price over the relatively short term. What does that mean? So how do you make decisions on whether assets are more or less valuable? And that's where I think you've got to be careful that you're making decisions on what's going to create the most shareholder value over the longer term, whilst not giving too much up in the short term, right? Because you've got to maintain that confidence. You've got to maintain those inflows of capital on a quarter-by-quarter basis, which you're all looking at on a day-by-day, week-by-week, quarter-by-quarter basis. But it needs to be in the context of, okay, where do I position myself longer term?
So thinking about the long term, I guess, versus the short term, you had Nicaraguan assets. We still have Nicaraguan assets. There was political risk concern there, correct? Right or wrong? Sort of the market had those concerns. We now also have Los Filos, where unlike the Nicaraguan assets, which didn't really have a trigger event for the political risk concerns, Los Filos has had trigger events that have prompted the political risk concern. How are you thinking about Los Filos for the long term for the company, and how are you approaching the political risk issues down there, perhaps differently, or how is it sort of evolving such that we can hopefully get the most out of that asset, whatever way we can sort of accomplish it?
Yeah, sure. And to be clear, every jurisdiction you operate has a level of political risk. It's just that the nature of the risk is different, right? If we think about Nicaragua, right, it's a great place to operate within, but there is still a geopolitical risk associated with it because of the nature of the jurisdiction. But the counter to that is we can go from permit to plant in terms of you know, apply for a permit, go through all of the same things we would do in Canada or the US, and we can come out 12 months later and be in the dirt, right? We can move things very quickly as a consequence of the appetite within the country to be able to progress things, so long as you do the right thing. So now coming back into Los Filos is that, you know, Los Filos has, again, in most people's estimates, has a very low valuation. But at 13 plus million ounces of resource with significant opportunity we can see to grow that asset base, is that it's worthwhile to go through these discussions we're going through now with the communities to ensure that we can come to an agreement with the communities that sets this asset up to be able to generate maximum value for all of the stakeholders over a long time. You know, arguably, we could go in there and we could resolve this tomorrow by go back and say, hey, we're going to come back to the regime of, you know, of payments and land access payments that existed 2 years ago. But we don't believe that's the right thing for all of the stakeholders going forward, because it's going to end up in a suboptimal outcome over the 20, 30, 40-year mine life that can be. So we're in a position now where we can have that discussion too. And so this is not really a political issue, nor is it a social issue. It's really a financial issue, because you have a stakeholder that's in a negotiation to say, how can I get maximum value? But we've got to make sure that in part of that, we're doing the right thing for all of our stakeholders for the longer term, including those people who are negotiating today.
And so just for the audience's sake, Los Filos asset has 3 communities around it, one of which has proven, you know, challenging to work with, and the other 2 have been a little easier to work with. I know you guys have looked at and are considering ways of sort of reorganizing the mine to sort of remove that 3rd community from the equation altogether. Has that, I mean, is that how, it doesn't sound like that's your preferred route. Am I correct?
Yeah, no, absolutely. I mean, you know, I look at the landscape, which is Los Filos, and I think of the value that can be extracted there, and I think it's huge. You know, we look at Torex across the valley, which is a similar deposit, right? And they got a market cap of, I don't know, $4 or $5 billion, whatever. Jody and the team, they've done a great job there to deliver that, right? The opportunity kernel that sits with Los Filos is the same value, right? Right now, that's an additive to what we're valued at today. So the opportunity to be able to extract value there is great, but it needs to be enduring, and all of the stakeholders need to be able to be participating in it. So, no, I now coming back to the 2 community plan, is there an opportunity for a 2 community? Yes, there is, but it's a suboptimal outcome, right? And it's not that it's an outcome that doesn't make sense. It's just that, again, as we take that long-term view, what's the best opportunity for the long term? We're taking every decision we made today is based on all of the factors that are in front of us today, but it's always considering the long term, right? I mean, again, I'm careful what I say here, but we could, you know, arguably, we could resolve that issue very, very quickly by going back to where we were yesterday. But we don't believe that's the right thing for the asset, for the 3 ejidos, for the municipality, for the state of Guerrero, for Mexico, and for our shareholders. We believe that's a suboptimal outcome in the medium longer term. So we're going to stick to our guns, and we're going to come out with the best outcome that we can within the constraints that are provided to us. So, and that's part of the reason why the communities that have it, we have got 20-year land access agreements fully ratified by the communities with 2 of the 3 communities. And, you know, there will be a solution to this. There will be. Now, whether it happens next week or next year, I can't tell. But the indications are that, you know, people want us there. This is not an anti-mining, or there's a kind of an underlying environmental issue or social issue. This is truly a financial negotiation, in my mind.
No, I think that makes sense, and definitely long bemoan the discussion on the sell side of selling Los Filos. It never made a lot of sense to me. So now,
again, if we look at again, I'm not saying we would, but
yeah,
if you're looking at it, if you can progress that social issue, it's worth more too, right?
exactly.
And that's where you make the decisions based on the best information. So how do we progress that to increase shareholder value, right? And make the next decision. And the next decision would be, let's get social in place. Then let's look at what that plan looks like, given where we end up from a social perspective, and how do we create maximum shareholder value.
No, and as I said, I think that makes all the sense in the world. It always struck me that this discussion of shareholder value and stakeholder capitalism, they had somehow got the conversation reversed. And in order to create shareholder value, you have to first get all the stakeholders in line. Once all the stakeholders are in line, shareholder value will flow sort of naturally. It's not a question of the other way around or whatever occurs in the ESG conversations that frequently happen. So I guess, looking forward, obviously you're opportunistic, and so one never knows what might come down the pipeline. But I have to imagine that the focus now for the next year, maybe year and a half, is getting all the assets up and running and humming to the best of their ability. After that, it's Castle Mountain Stage 2 and Valentine Phase 2, I imagine. Is that the growth path? And what sort of timelines do you envision on some of those additional growth opportunities, that organic growth opportunities?
Yeah. So, and I think you've summarized it well, Will, right? It's about delivering into commitments, which is basically demonstrating operational excellence and having a team of people who are focused on ensuring that the assets we're operating are operated to their full potential. That will then allow us a level of disciplined capital allocation, because it'll generate funds that allow us to deliver the balance sheet, which will position us to be able to self-fund high return organic growth. And the two things that are immediately in front of us, we talked about fearless, but we're talking about the two things that are immediately in front of us are Valentine Phase 2, and that's to take Valentine from 2.5 million tonne to 4.5 to 5 million tonne, right? There was always within the feasibility a concept to go from 2.5 to 4. But over the last 6 months, we've advanced the work to be able to see there's a great opportunity to go to 4.5 to 5, which is then, call it a 25% increase in throughput from the same base plant. So the incremental capital and the return on that's going to be, really, really attractive. The timeline for that is that, I would anticipate going to the board at the end of Q1, early Q2, and requesting full funds approval. Big round numbers, and now I'm getting way ahead of my disclosure skis. But if we think about it, I don't know, just let's throw a number out there, and let's call it 350 million US, just say, right? And you look at the 350 million US that could come from a 25% increase in production, that's going to be very, very attractive, right? And the timing for that would be a 26 into 27 with a 28 build, with the majority of the spend in 27. So if you think about it from again, let's step back and assume that all of our assets remain in the portfolio and we're creating in excess of $1 billion a year in free cash flow. The majority of 26 goes to servicing debt. 27, right? We've got build at Valentine, so call it $250 million for the sake of, and I'll use these numbers because I can do it on the fly. We've got 350 million from the investment as a total, call it 100 million or so next year in 26. So it leaves 250 million in 27. Assume that the balance of it's in 27. It's going to dribble into 28, but call it 27. So that means as your 750 then shrink, you've got no debt materially. Your 750 shrinks, sorry, your billion shrinks to 750. Castle Mountain, we have a definitive outcome in terms of record of decision in December of 2026. So if we now consider Castle Mountain commencing the build in 27, and let's big round numbers, call it $750 million worth of build, of which 250 is in 27, with the balance of 500 coming out in 28. We've now got $500 million of growth capital eating into our $1 billion of free cash flow. So we've got a $500 million of cash sitting in treasury at the end of, in addition to where we end 26 at the end of 27. You've got another $500 million consumed out of your $1 billion in 28. So now you've got $1 billion of cash net of organic growth on the balance sheet, and you've grown production to 1.2, 1.3 million ounces with the addition of incremental ounces at Valentine and 200 plus thousand ounces a year coming out of Castle Mountain. So you've now tiered up your jurisdiction.
Yeah, and with that in mind, I think the question obviously many shareholders would probably ask is, you've got that extra cash. Obviously, from this discussion, it's going to be a question of highest and best use, whether that's acquisitions or capital return. And if it's a better use to acquisitions, I support that wholeheartedly. But when you think about capital return to shareholders, are you more of a sort of a fan of the dividend or more of a fan of share buybacks, or is it a question of the share price that you're buying it back at?
I'm more of a fan of what the shareholders want. And I don't mean to be deflective, but
Yeah.
and not be tongue in cheek, right? But as an investor, I'm only interested in what's going to make that share price go up. I don't buy this stock for a dividend, but some people do. So maybe having a dividend would be. So we think about how do we return capital to shareholders is really about how do we return value, right? So everything we do needs to be focused on increasing share price. And if a dividend is part of that or a share buyback is part of that, right? We're going to be having pretty interactive discussions, my guess is that, within a year about what are the people that own the business are really looking for. And there is no panacea, right? If you're an Australian pension fund or superannuation fund, you may be looking at a dividend. If you're a US investor or say a European investor, dividends are not very attractive. So, again, we're not going to have a one size fits all perfect solution, but we're going to be in a situation where we can start having intelligent discussions about what is most attractive for. But what we need to do is make sure that we maintain significant levels of liquidity that allowed us to be opportunistic if opportunities present. But right now, what we want to do over the next year is provide the framework to allow for that to be realized. Given we've got buoyant gold prices, we've got lots of value to be able to surface from our existing assets, and we need to key things up to ensure that organic growth, we know exactly what it's going to take from a capital perspective, from a human resource perspective, so that before we make a commitment, we are fully funded prior to commencing that work, right? And that's getting a level of confidence. And we're in a really wonderful situation. We've just come out of Valentine phase 2, Valentine build. We know what things cost. Rolling into phase 2 next year makes sense. We've got a level of definitiveness around Castle Mountain in terms of the timing of, because of being in the FAST-41 process. Now we'll continue with the engineering to tighten those things up. So this time in a year from now, we'll be in a position to be able to go out there and have 80, 90% engineer complete with very, very high levels of accuracy on capital demands, which allow us to be able to plan our business. And then we say, what do we then do with that surplus cash we have available to us, and distributing dividends, share buybacks, or again, potentially we could be in that M&A space. But, above all else, what's most important to me is no further dilution. No further dilution unless it results in a very short-term increase in share price. If we think about the Caliber model, we raised at 60 cents. We saw a 5-6-fold increase over that 4 or 5 year period. But we did dilute during that process, but we did it because it was stepping stones to enable to, right? Dilution is not a bad thing so long as it comes with share price appreciation.
Couldn't agree more. Important for mining investors to understand. So you mentioned the FAST-43, and I know we're coming up on the hour. And if anyone's got any questions, feel free to put them into the chat, and I'll start passing them on to Darren. But you mentioned the FAST-43 program in the United States. For those who don't know, Castle Mountain is a gold mine in, of all places, California. Not a usual jurisdiction anymore. But maybe could you just tell us how the process of getting into that program has sort of went, and what working with the Trump administration, I guess, to get into that program and get the permitting accelerated, how that process went?
Yeah, no, well, it's an application you make, and again, the Castle Mountain the FAST-41 process is administered by the US Federal Permitting Improvement Steering Council, within it. And
A
that's a
mouthful.
function that reports through the administration. And what it is, it's not focused on resources. It's focused about critical investment in the US, critical infrastructure. And from memory, we were only the second resource project to be considered into that process, right? And we made that application here in Q3. We've got accepted in August 8th, I think was the date. They come out with a definitive program. And what it does, it's a body that sits above all other bodies that quarterbacks all of those regulatory authorities and ensures that they deliver into schedule. It does not guarantee the outcome, but it guarantees there will be an outcome, a record of decision. But it's unlikely that you would be considered into a critical investment infrastructure project in the US if it wasn't anticipated to be favorably received. So no, it's a relatively straightforward process, but it's about all of the great work that's been done over the years by the folks at Castle to be able to demonstrate the robustness of the project, why it's important, and it's critical in that part of the world as well. It's jobs, it's livelihoods. We've got demonstrated kind of responsibility and being a good operator there with Mesquite in the same county, San Bernardino County, over the last 30 years. Right. So there is an appetite there is acceptance from the municipality and the state. They want us to be there, but we have to have federal permits first because of the way it works in the US. So no, it's been a great process, gives us definitiveness, allows us to be able to plan the business, which is the single largest issue when you're operating in a lot of tier 1 jurisdictions is that you can plan for, but when will you have? Now we have definitiveness. So it removes
do
one
you
of the
think
uncertainties.
you've built mines in a wide diversity of locations? Is this program and this sort of idea of someone quarterbacking and ensuring that documents keep moving forward? Is this? It's clearly an improvement over what the U.S. had prior, but how do you think this compares to some of the other jurisdictions you've operated in?
Well, I think it's recognition that there's probably some ineffectiveness in the process within the US. So, and it's the desire to have that level of investment. So there's kind of more of a pragmatic approach to how can we remove the obstacles that are getting in the way of the US economy being able to progress as a consequence of that investment. So I think it's a pragmatic approach to removing some of the bureaucracy. And then you got to kind of, maybe there's other things happening in the background to be able to streamline some of the organism that exists from a US perspective, right? So it's kind of like a lot of businesses you'll see they'll put on bureaucracy and process, and then they'll work out, shit, this isn't what we want. Now we've got to back it back. We're seeing you might go through that now, right?
Mm-hmm.
They've talked pretty openly about a reduction in people as a consequence of, but the most significant thing you can do as a business is don't put that on. It's like weight. Right? Weight. It's much more fun to put on than take off. So don't put it on in the first instance, right? And if it's put on the weight, whatever you can never take off all of what you put on. And I can subscribe to that from personal experience, right? So it's just like, don't put it on.
As can I.
Yeah, you know what I mean? So it's just like, so that's where we're interrogating the business and saying, why are we? So I think that the US is going through, it's a sensible approach. And it's, again, it's a big organism. It takes a lot of time to change. But I think it's a sensible thing. And remember, this I think started in the first Trump administration, but it went through the last one as well. So no, it's a good thing. But compared to other jurisdictions, like I say, every jurisdiction has its idiosyncrasies. But US and Canada are very thoughtful, very deliberate in their assessments, and sometimes the bureaucracy and the politics can get in the way of the pragmatism and the true assessment. But you do need to ensure that you have an appropriate level of engagement. As Castle Mountain, we just went through the public comment period. We had the public meetings here on November 5th, and now we're soliciting that feedback. But again, we won't know till we get through it. But indications were that the meetings we had were very positively received by the stakeholders.
Okay, great. So that we've come up on the hour, and I know you were in London and are now about to go to Greenstone, so we don't want to hold you any longer. You've got, at least for shareholders like me, you've got more important work to do than talking to me.
Nothing's more important than talking to the people that own the business.
Well,
right?
fair enough.
Because it
Fair
is
enough.
critical that you understand and everyone understand what we're about, where we're going, because what we want you to do, everyone to understand, is what we're about. And then people can make, just like we do on operating the business, they can make the best possible decision they can in terms of deployment of funds and say, hey, do I like what I hear? Do I like what I see? Do I understand the fundamental business proposition? If I do, then invest in. If don't, that's everyone's choice. But I do think there's a good opportunity here with Equinox for those that do. So having this dialogue is fabulous, and I very much appreciate you taking the time and setting it up.
Well, I appreciate you taking the time, and I will say, as I mentioned before, longtime shareholder, first time talking with you. Uh, uh, Everything you said resonates, and so I think it's a very sensible approach to a. I mean, it's a sensible approach to a junior, but it's also a very sensible approach to a mid-tier or a major. It applies sort of across the board. It's deliberate and thoughtful, and with a focus on shareholder value creation in a way that I think makes sense. It's tangible and that people can wrap their hands around very easily. So, again, this was great. Thank you very much. And we don't have any questions, but I'm sure if anyone's got questions they haven't answered, we can get them to you or Raylan or any of the other team at Equinox.
Yeah, happy to. If anyone comes up after the call, please feel free to reach out. We work for you, right? We work for the investors. That's the reason we exist. That's the reason I get paid, right? So I know who my client is, right?
And I
So
don't think you
happy
hear
to
that
engage.
from management very much anymore. So that's great.
Yep. And like I say, what interests you fascinates me, right? Because I have a significant amount of my net worth involved in this product, right? So your feedback is
Okay.
critical to our success.
Okay. Fantastic.
Right.
So thank you, Darren.
I appreciate it, Will. Pleasure. And everyone have a wonderful day.